Well, as we roll through Memorial Day weekend here, we get into the summer. What does summer bring? Obviously, we know spring, summer, biggest time people move, most listings, most active sales. Obviously, that's when the real estate market is thriving, it's busy. As we keep watching inventory in places like here, San Diego, where I live, we are just not getting the listings we want. And nationally, we are starting to grow and hit the trends we like. Still nothing aggressive, but what I'm thinking about, we have tornadoes, thunderstorms, flooding, hurricanes approaching. We already have major insurance problems in places like California and Florida where you're just getting dropped left and right. It's out of control. And as we go on with summer, with all these crazy storms, and as I shoot this video, over Memorial Day weekend, there was another slew of storms that moved through the Midwest, Kentucky, Oklahoma, I believe. Major damages, major tornado damages. And how are we gonna get this insurance problem in order? It's just getting worse and worse, it seems. On top of the storms, how's housing gonna do it? This summer is gonna be filled with so much data and news. I think it's gonna be something to remember. Number one, we have an election coming up. Number two, these two guys are gonna debate. Can you believe that? Number three, we've got the Summer Olympics, we've got hurricane season coming, and on top of all that, are we gonna get the Fed to cut rates? This summer for housing, I think, is going to be out of control. It's gonna be nothing but data. Hopefully, with my fingers and toes crossed, we get some good news because man, we need it. We need Feds to cut rates. We need inflation to keep coming down. I hate to say it, you don't want pain in the job market, but if we see the Feds cutting rates, that means they see pain in the job market. And with that being said, that means people are gonna lose their jobs. So will there be more inventory on the market? I don't know. Will rates drop into the fives by the end of the year? I just don't know. But will the Feds cut rates? That is the $1 trillion question. That is what the global market wants to know too as well. Us here at home, we're wondering. And on top of that, we have looming wars that don't seem to be stopping, giving up. There's always something to unwind. But hey folks, welcome back. It is another week. First of all, I'd like to say before we just jump into the video, thank you so much. Happy Memorial Day to you. Yes, you're watching this, it's past. Maybe you're on a trip, maybe you're out of town, maybe you're on vacation. A lot of people traveling, but we need to stop and take a moment and remember for all those that have done for our country, that have sacrificed lives to offer us such amazing freedom. A place like this where we can actually buy a home, we can own a home. The government doesn't come and steal it from us. We can start a business, we can have jobs. Our kid can run around free and safe on streets. I know you might disagree depending on where you live, but look, go to other countries. America is the best. And that is because we have an amazing military that protects us. But before I just let that go, I also want to honor and thank you for all those family members, the kids, the wives, the husbands that have to stay at home while people go off to war, go off to overseas battle, whatever it may be. They're at home dealing with the kids, dealing with the stress, dealing with the normal life that we deal with. And on top of that, they have a significant other that's out to sea, out fighting, wherever they may be. It's super stressful, super frustrating. And here in San Diego, we help so many of our vets, military folks buy and refi homes. We see the stories, we hear about the stories and, sacrificing at home and sometimes getting that call to say somebody's not going to come home or not make it. I could not imagine. So I just want to stop and say thank you very much to all the military. Without you, we would not be here. We would not have what we have. So thank you. So moving on, if you guys don't know who I am, my name is Kenny Simpson. I focus on 1-4 unit financing. I've been doing this for almost 20 years. Gosh, I can't believe it's been that long. Helped over 5,000 clients, billions of dollars of loans. And I'm here to educate you today, to provide you context on what's going on in the market, try to break it down, what's going on in housing, maybe some consumer finance nuggets, and also all that fun real estate news that you hear out there. What in the world does that mean for you? Whether you own a home, you're going to buy a home, you want to refi a home, you want to buy an investment property, you just want to know what is going on in the market. Did you know in the booming markets, take LA, San Francisco, New York, Miami, probably certain parts here in San Diego, that the high end, 75% of those offers, 75% of those purchases are done with cash. That is how much money wealthy people have out there. So they are doing just fine buying these big properties. So at the high end, the low end, even at the low end and the entry level, people have cash. How do people have this cash? Honestly, I don't really know if they took exits, if they inherited, if they made it, if they cashed out of a house, a business. I don't really know. But guess what? There's a lot of cash buyers out there. So if you want to compete with them, I'm going to give you a little bit of strategy. So stay tuned in this video because I'm going to tell you how my buyers are beating cash offers in today's market by one simple little trick that a lot of people might not know about. And I was reminded this last week of a customer, a new client that lost a purchase, and they're going to use this strategy. And they're like, if I had that strategy and I could do that, I would have won the offer. So stay tuned for that. What else is going on this week? The data is usually lighter. Obviously, it'll be a slow week moving in as people are out of town, coming back in town, probably feeling hungover from a long weekend or just being really hungover from partying too much. But anyways, we do have, at the end of this week, let me take a look so I can make sure I'm not screwing this one up here. Looking as we post it. By the way, if you're not following me on Instagram, we post what is going on every week. So every Monday. So Tuesday, consumer confidence. Wednesday, nothing. Today's Memorial Day that I'm shooting this. Thursday, initial jobless claims, retail inventories, wholesale inventories, pending home sales, personal income on Friday, personal spending, PC index, core PC index. So that is what we have this week. Light on the data, but hey, we will keep watching because we're watching the feds, we're watching that inflation, we're watching the jobs market. We're also watching you consumers to see if you're pulling back as we continue to see that. Mortgage rates, I'm just going to say they're still chilling. 10-year just seems to be sitting around the 440. As I mentioned prior, we've gotten relief. The 10-year treasury and the 30-year fix, that spread was between the difference is usually 180 to 200. That went all the way to 3.10. That has come back down to 250. What does that mean in English, folks? So if you just heard all that and it sounds like, Kenny, what did you just say? What I said is from last year to this year, rates have naturally, because of the spread between the 10-year treasury and 30-year fix, just think of those two things, has come down 50, 60 basis points. So that is a win. Not enough people are talking about it, but I've been talking about it and I want you to know about it. Okay. So Freddie Mac came out and said they want to do these mortgage seconds, basically fixed rate seconds, because a lot of people are, if you have a Freddie Mac mortgage, they're going to give you some proposed second. I'm not sure what the terms are, the deal is, but they want to give a second out. And look, there's tons of HELOC seconds, all that going on. They think they're going to give out $1 trillion of loans, which that means $1 trillion of cash people have access to. Well, a lot of officials started blowing up, not liking it. Why? Well, let's take a wild guess. No, they don't want you to not have a second. But as I mentioned, this is not a HELOC. This is a HELoan. So that means if people take out this money, it goes straight to them, straight to the bank account. So that is like putting another $1 trillion into everybody's pocket. What do we think that will do to inflation? Well, folks, let's back the train up. We got locked down in COVID. People paid down their credit card debt. Saving rates were at a all-time high. They're at 35%. Now they're around 3%. Okay. Credit card debt, remember, was paid down. People were not paying their bills. People were stacking cash. People were looking good. Fast forward to 2024, the credit card debt that was paid down to, let's call it $700 billion, has now gone up to almost $1.2 trillion. People were not paying on student loans. Now they're having to start paying on student loans. The 40% of you that have not been paying on student loans, oh, hello, October's coming. Your payment's due. Yes, 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 that's you. You have to start paying on student loans again. Also, you've racked up your credit cards. Also, you took out cash refis or you took out money out of your business. That's all happened during COVID. Also, you've tapped your equity of your house on a home equity line. What I'm trying to tell you, folks, first it was they blow through their savings, then they tapped their credit cards, then now they're tapping the HELOCs. Do you understand that we continue to fund this economy with money that people are just using from equity, from credit cards and things like that? So if you're using a home equity line to keep your lifestyle up, that will probably come back to bite you in the ass. If you're using your home equity line because you want to pay down credit card debt, or you want to build an ADU, or you want to redo your house, kudos to your buying investment property, that could be good. But using that to maintain a lifestyle is only going to hurt the economy and make this more challenging for us to get inflation down so we can get rates down and get that rate cut, the cut we all want. Moving on. Jobs data. Jobs data will reduce interest rates, as I go over this in this article with Logan at Housing Wire. Let's dive into it. Let's take a look. Why jobs data is more important than inflation for lower mortgage rates. To wrap up in this conversation, in this article, Logan's talking about originally the Feds typically focus on inflation. That's what they said originally when inflation was high. They said, we want the Fed's fund rate to match the PCE rate, which is not true. So now they're saying, after going back and forth, you have to read between the lines. They're really focusing on labor. They need labor to break. What does that mean? Probably to get the unemployment rate above 4%. The labor market has been getting softer for some time, but it hasn't broken yet. With the growth rate of inflation well off the peak growth rate of inflation, the Fed has turned more to a dual mandate. This means that we're in a cat and mouse game with the bond market and mortgage rates that have valued labor data over inflation for some time. I discussed total labor data to explain why the Fed has become dual mandate again in recent daily podcasts. So basically what that means, folks, is sometimes it was, hey, we're only inflation driven. Now we're looking at inflation and we're looking at the jobs. They want to see more jobs. They know if you're employed and you have money coming in, you will continue to spend. They know that. And that's why they're going to watch that. And that's probably when they see pain in that, you'll start seeing rate cuts. Until then, well, forget about it. Have you ever heard of TBD scenario, or aka to be determined, or a get pre-underwritten before you buy a home? Well, today I wanted to talk about that because I was just reminded last week that another client, a new client that was actually reaching out about interest rates, when we quote him, said, forget about it. I lost this house. Never mind. I'll reach back out when I find a new one. And I simply replied, how did you lose the house? What's going on? He said, we can only close in 21 days. I'm competing with cash buyers. I said, well, what if we can close in 10 days, remove loan contingencies? And he said, if I could have done that, if I knew that, I would have beat the offer. Well, bing, light bulb went off for him. Light bulb went off for me. Obviously, I know we have this product. We talk about it, but I wanted to talk about today. So what is this person doing? Sending us all their information. We're going to go ahead and pull credit. We're going to run them through the automated system. We're going to submit the file to the lender. They're going to pre-underwrite the loan. We're going to get a loan approval. We're going to get all the conditions clear. The only conditions that would be on that loan approval are appraisal if needed, title escrow, purchase agreement, insurance, proof of assets, down payment, wiring funds to escrow, the basic steps. So he's going to go in, offer a 10-day close now, remove loan contingencies, and guess what? He will now be able to compete with cash offers. Why? Because we can tell them they're already pre-underwritten. Why? Typically cash offers too want a little bit more of a discount. So when somebody's writing an offer and they want to be competitive, they can close in 10 days. They can remove loan contingencies. If they're putting down enough, they actually can remove appraisal contingencies. But typically somebody will write a little bit higher offer than cash because cash is expecting to get a deal. And if they can't get a deal, they might not accept the counteroffer. Well, my client will go in with a 10-day close, remove at least loan contingencies, not sure about appraisal, and be able to compete with the cash offer. But most likely we will beat it because we'll call the agent and we'll tell them, we're so great and you should take our offer. But anyways, that is a TBD scenario. If you want to learn more about it, hit me up because honestly, they're a game changer. And if you're kind of our cookie cutter borrower and you're in a very competitive market like San Diego, California, places like that, you should definitely do this. Why not take the pressure off you and be in a more competitive position? Also, another article about 20% down. Yes, we talked about this a few weeks ago, that it's not the norm. But you know what? It keeps getting brought up more and more and more. About 77% of future home buyers have started putting money aside for a down payment, according to a new study from Clever.com, a housing and real estate research site. Buyers may need to put more money down to avoid mortgage insurance costs and even less monthly payments, but 20% is definitely not required, said Chief Creditor at Realtor.com. What I want to say about the 20% down is that there's this illusion, like I don't want to put 20% down because I don't want to pay mortgage insurance and all this stuff. And the crazy thing is that people come and they get a quote from us and then they realize that the mortgage insurance is only $80. They're like, wait a minute. They have this illusion or delusion or something where they think mortgage insurance is like $500, $600, $1,000. Folks, literally, if you have good credit, you're putting 10, 5% down. Mortgage insurance should be $60, $80, $100. It's not much. So people are kind of like, well, shouldn't I keep my cash? I'm like, well, that's your kind of like mindset. Do you want to keep the cash? I think it's smart to keep the cash. When you buy a house, there's always something you got to do. Furniture, improve stuff, fix stuff, all that stuff. So why not sit on more capital, have the cash, put yourself in a better position? So 20% down, again, in this article is not justified. This article was interesting, and this week I jumped into it. Listen to this one. Ready? How about you hire your kids this summer at your job, your company? You could score a tax break for hiring your own kids this summer if you follow the rules. If you're self-employed, hiring your kids can provide tax benefits. You could deduct wages as a business expense and fund your child's Roth retirement. So what do you need to know this summer if you're self-employed before hiring your kids? Let's jump into it. Before hiring your children, it's important to know state and federal labor laws along with tax rules, experts say. Of course, some states pretty much ban you from hiring children under the ages of 14 under any scenario. If hired, your children must do real work for the business and their compensation should be reasonable to match their task. Record keeping is non-negotiable. Not only helps you navigate the tax landscape, but also serves as valuable resource of any question about your child's employment. Payments to children are subject to income tax withholding regardless of age. For an IRS, hiring kids as W-2 employees and withholding tax covers your bases, but they'll get full refund of tax paid if they're under the standard deduction. For single filers, it's $14,600. So if you're going to hire your kids, just make sure, talk to your CPA, just make sure you follow the laws and make sure they're actually doing work and you're documented. Look, in our industry, people are hiring their kids to do marketing, going on Instagram posts, YouTube, on posters, flyers. You can hire your kids to drop off flyers, help organize stuff in the office, whatever it is. Great strategy to get the kids in the work mode, get them outside to do something, even if it's for a week or two, but also earn a little bit ching, right? So maybe they can take some money and they can go spend it on something they want. And they'll be like, man, I worked that hard for that and that's what it costs. I don't want to buy it now. Well, guess what? Now you know how we feel, kids. And wrapping up this week, this article, I'm not sure how I feel about it. It seems like we're in this era of free money, era of giving away money, era of helping other people, which is great. But last time I checked, if you don't have money to give or help people out with, it's kind of a problem. And if you're borrowing, that would be like you borrowing from your kids' to help everybody out. That's going to turn out to be a disaster. So in this article on CNBC, Elizabeth Warren wants more student loan borrowers to know bankruptcy is easier now. Oh, lovely. Well, let's see. Over the years, policymakers added extra stipulations for the discharge of education loans, expressing concerns that young people would try to ditch their obligations after graduating. I agree, they would. Just saying, kids, sorry. As they grew up, borrowers were often asked to prove a certainty of hopelessness, and government lawyers battled most requests. Between 2011 and 2019, more than 99.8% of borrowers who filed for bankruptcy did not get their student loans discharged, the senator wrote in a letter. Discharging student debt in bankruptcy is now easier. Lovely. Thanks. Cool. Go to school, rack it up, and then just go file bankruptcy. That is really what we should be educating our kids on. While government used to fight discharge aggressively in almost every case, there is now a new policy to agree when the borrower can show financial need and history of good faith efforts to pay the loans. I've helped several people take advantage of the expanded ability. Many borrowers are not aware of changes. Here we go. More than 43 million borrowers in the United States carry a total of $1.6 trillion of student loan debt, and more than 2 million borrowers have been repaying those loans for the last 20 years. DOJ and ED must work harder to encourage borrowers to seek relief and deliver what we requested. The Department of Justice and Education Department did not immediately respond. Many law firms continue to refuse to take on these cases she had because of the low success rate in the past. She said one attorney told her that he did not want to spend the time updating his strategy on the new procedure before the election. If former President Donald Trump wins the election, experts say there's no guarantee that the more lenient approach would come to an end. But for me, this other attorney says, that makes it even more important to take advantage of the litigation approach now rather than waiting, Gill said. I told current clients that if they want to pursue discharge and are eligible, they should do it now before November. Sorry, guys, I don't agree with this. If you go to school, you rack up the debt, you should pay it off. That's why you're going to school. Shouldn't you be going to school to come out, get education? I do agree that if you came out and you had some crazy medical condition, disability or something like that, could they discharge it? If you can't afford it, sure, why not? There has to be some stipulation there. But if you can go to work and get a job and you decided to go to school and you can't pay it back, you should have thought of that before you take out the loan. But another reminder on the back of all this, that if you are going to go get bankruptcy, good luck getting new credit cards, car loans, buying a home, starting a business. So you will be affected on the long term. So going to school, to getting your education, to come out and getting that good job is one thing. But now that you're an adult and you want to file bankruptcy, good luck getting anything good with credit card debt, car loans, house loans, business loans, things like that. You're going to be majorly handcuffed with your hands behind your hat back, and this will hinder you in the long run. I don't agree with this at all. I think if you have the ability to pay, you should pay. I think we're giving too many loopholes for people to play games about all this stuff. But hey, what do I know? I'm just a guy that did not graduate from college, but I paid my own tuition and I already paid all that crap off, but I did not graduate. But I'm here, just a guy working hard, self-employed, building a business, paying my tax on time, and hiring people and trying to grow my team. But the government at some point is going to have to stop spending money that we don't have, because it's going to continue to affect all of us long term, and our kids are going to get hammered. So anyways, guys, that's it for this week. Thanks for watching. Whatever side of the aisle on, it doesn't matter. We don't have money to spend. We don't have money to keep bailing out people. You guys see the debt. You clearly see at some point in the near future, folks, we're going to have to, unfortunately, hit a brick wall, which we're not going to be able to knock over. We're all going to have to face this reality that we have this mounting debt we cannot pay for, and we're not going to be able to help other people because there's not enough tax dollars, not enough money out there to help. And what are they going to do? They're going to start coming after you that have the assets and the money to start taking it from you to paying people that basically need the bailout. Thanks for watching. Have a good week. Talk to you soon. Love you guys.